Andrew, thanks so much for coming on Wall Street Unplugged.
Hey, thanks for having me, Frank. How you doing?
I'm hanging in there. How you doing, man? I see you on your boat all the time. I see you cooking all the time. I mean, your Twitter feed. What give you a Twitter feed? Because it's actually the stuff that you post is really, really cool. It makes me want to come over your house every day.
Andrew Horowitz, just one word. That's my handle on Twitter. Don't fall for the fakes. That's a big thing these days. These fakes on Twitter.
I know these fakes.
That they come on and then they start DMing my followers who think they're following me and asking them for Bitcoin and to kind of throw them a bone there. But and speaking of a bone, this weekend was my birthday. And
happy birthday. Happy birthday.
Thanks. I had a 50-day dry aged bone-in ribeye from some Sterling something farms. And I cracked it open this weekend and I did a reverse sear on it on the smoker and then pushed it into a cast iron skillet with some bacon fat and some butter, and man, it was a heart attack for a meal. It was delicious.
Definitely worth it, man. That is awesome. So listen, happy 65th birthday, buddy.
yeah, thank you. Thanks, Frank. Appreciate it.
Definitely a lot younger than that, but yeah. So I mean, let's get to the markets because it's been crazy, right? I mean, we all know the economic backdrop, right? We love talking about the economy. We try to make it as interesting as possible on our podcast, your Disciplined Investor podcast and mine. Again, so it's not just about bell curves, about what everybody does every day. So we make it interesting. And when you look at the backdrop where the Fed went on television and said, listen, it is a week ago, pedal to the metal, low rates forever. Yes, we see rates rising, and that's a risk, but it's a risk the Fed sees also, right? We all see it. Usually you have to worry about the risk you don't see. And if they want to implement yield curve control or something else to control that, we'll see. But everybody's like super bullish now. I mean, you can't really find a bear out there. I don't see anything on TV or in the news of people saying, just any bear saying, now's the time to take money off the table. When 3 weeks ago we saw it when the NASDAQ crashed. We're not really seeing that now. Does that make you, a little nervous?
Well, the first part is the rate issue. And of course, the Fed, their job is to cheerlead. That is their job. I'm not saying that, in a weird way. That is their job, to make sure there is confidence in the markets, that they're going to make sure that there's a safety net, that interest rates are at a level that will promote the velocity of money. And that's what they do. If you ever watch Jay Powell in the last couple of weeks, everything he said is an exact word for word, letter for letter duplication of what he said the week before and the week before that. They are committed to this. They are going to make sure that there are two mandates. They're going to let inflation run a bit because they're going to do averaging. Very, very careful with his words. The problem is that they are going to, and they're about to enter into an inflationary period right now. There's no question about this, by the way. It's called the base effect. And you're going to start hearing more about this because they're really concerned about making sure everybody is prepared for what is about to happen. And what that means is that while we're seeing that inflation running from anywhere from on headline numbers of 0.1 to 0.3, depending on what month it is, on a month-over-month basis, and on a year-over-year basis, we're seeing maybe 2%, 1.92%. It may go up a little bit, down a little bit. Here's the problem. We're about to do a comparison on the base from back in February, March, April of last year, when there was a massive deflationary plunge in overall prices. Now, what we're going to start doing is looking at that as the base when we start doing our calculation to say, okay, what's the differential between where we are now and where we are then? And you're going to see some very, very high levels of overall inflationary looking numbers for the next 2, 3, 4 months. And then it's going to stabilize. The Fed's been trying to tell us it's transitory. It's going to be as pop, don't worry about it. It's going to go back to some normal levels once we get past that. But the question is whether or not markets are prepared for it, whether or not we're going to be able to deal with if we do see a 5% year-over-year inflationary number for one period, 2 periods, 4%, whatever the exact number is. And I think that there has been a lot of, I would say, education in the area of this, but it's going to be something to contend with. That's the first thing. The second thing really about rates, what's happened is that, yes, we have a better economy. Things are moving along well. Fed is still buying a total of $120 billion per month of overall bonds, right? However, there was some selling that went on from principals and the dealers recently because of the question about the expiration of what was called the SLR. Not a lot of people heard about this. The supplemental leverage ratios that was put into place back some time ago as a backstop, that in the event that the banks essentially needed to backstop some of their monies were allowed to remove treasuries without getting into all the nitty gritty, remove treasuries from the ratios, the financial leverage ratios, and therefore would not have to worry about it, thereby allowing them to hold those treasuries. Not a lot of banks took them up on this. However, there was enough on the books. There was about $80 billion worth of sales over the last 3-4 weeks, and that drove bond rates up a bit. Now you'll see them kind of at a point where there was a question of whether they're going to extend it, whether they're going to cancel it. The Fed came out and said last week on Friday, you know what, we're going to let this expire on March 31st, 2021, just as we had anticipated, basically put it in there for a year. And it's pretty much now a point of, okay, we got it out of the way. There's no surprises. We have clarity on this. And markets are now taking rates down from where they were, 1.77% to about 1.65%, which is still a little bit hot from where it was.
Yeah, you said a lot of interesting things there. Especially the one. Yeah, no. But one of the most things that stood out to me really is the 4%, 5% inflation. Is it possible for us to see that kind of inflation? Because the way they structure it in the CPI, we all know. I mean, you can look at electricity costs, you can look at tuition costs, you look at food prices, you look at gasoline prices, lumber, copper. I mean, lumber and copper are through the roof, especially lumber.
Yeah.
Home prices in general, we're all seeing a massive amount of inflations. But again, none of that matters when it comes to what we're talking about here, because in terms of your investments, it matters what the Fed is going to do based on this inflation. But if we're not seeing over 3% inflation now, are we ever going to see 4 or 5% just the way it's structured, where a lot of real estate and rentals go into that and stuff? And we all know it's a BS indicator, but that actually is what the Fed's looking at.
Well, the Fed's actually looking at the PCE indicator, which comes out this Friday, I believe, the personal consumption expenditures level. Mm-hmm. That's their preferred metric. Don't forget, there was a great and a very famous, I think it was a Jerry Lewis movie. There was a Jerry Lewis movie that was entitled "Don't Raise the Bridge, Lower the Water." It's kind of like, if you can't do one thing, we'll figure out another way to do it. Mm-hmm. And what that is all about is there was a significant change a few years ago that looked at what inflation is now, and it changed a lot of the components to show that there really isn't a lot of inflation. So they kind of lowered the water. If you go to shadowstats.com, there's a good amount of data there utilizing the old statistical calculation of what inflation is, and it's much higher. It seems much more realistic than what we have today. Same thing with unemployment. All the calculations now are much different than they were a number of years ago. If you look at Shadow Stats, they have great information on there about the core inflation, as well as comparison of where inflation is now, and also the unemployment, the U6, all the numbers that go into the unemployment, what the official numbers are now, what it would look like if they didn't tinker with the numbers. To answer your question, I think we're going to see a momentary inflation spike, probably March and April, because we're comparing it to the year ago period, and that's what everybody looks at, year over year numbers. Month over month is important, but it's a very noisy statistical measure. So you're going to see it. It's going to spook some people, but I think a lot of people that know what's going to be happening and why it's happening are going to be prepared. I don't think it's going to be 4% inflation over the next 5 years on that kind of clip.
Yeah,
and there's a lot of reasons why, by the way. There's a lot of reasons why. You have technology. You have the fact that, they're doing all sorts of things to try to tame this down. There will be inflation. It's probably going to be running closer to 2%, maybe 2.5% than there is at 1% or 1.5%, but it's not going to be 4%.
Yeah, which means the pedal to the metal still with that economic backdrop and trillions of more stimulus. Goldman Sachs just came out with a report saying that another $4 trillion by September, $2 trillion plus for infrastructure. Again, a lot of things that we know, but now when we look at valuations, I mean, I saw this stat, and this is right up your alley here, but it's 70% of stocks are now trading more than 20% above the 200-day moving average. I mean, to put that in perspective, it's never been that high dating back to the 80s, early 80s. I mean, just so it's getting – so what does that mean? The risk-reward profile is tough. You're going to take on more risks, stocks more expensive, and the reward isn't going to be as great because a lot of these stocks have run up. First, it was growth. Now that pulled back a little bit, still a little off its high, maybe 5-10%. And now you have the value, cyclical names, but maybe utilities or consumer staples. But how are you playing this? Because I think we all understand the economic backdrop and how powerful it is in terms of assets, but eventually it doesn't mean that everything can continue to go up at stupid valuations where you're paying, $25 for a candy bar.
Right. Well, you have small cap value right now. That sector is up about 25% this year. It's about 21% above the small cap growth sector. This is a total reversal of where we were last year. Everybody all of a sudden got on the inflation higher train, started buying the banks, small cap banks, the energy stocks. Those are really packed into that small cap index universe. large cap value is also about 8% or so higher than the large cap growth department there in terms of the sectors. And then you have the Dow Jones beating the S&P and beating the NASDAQ this year. So it's kind of a strange situation where everybody gets to one side of the boat very quickly right now. They follow the trend. Everybody gets there, and all of a sudden they get off of that, right? As soon as they started to realize that interest rates were going up, they started beating the crap out of all your growth names, right? All the tech names, a lot of the healthcare names, well off of their highs. I mean, well off the Apples, the Googles, Teslas, you name it, right? And for good reason. The reason was that even though a lot of the pundits, Frank, what do you think of this? All these pundits on TV talk about how, hey, low interest rates could really be very supportive of higher multiples, right? We've heard that for 2 years, 3 years, 5 years, whatever it is, right?
Yeah.
Then they come on, they're like, hey, higher interest rates are really good also, because that means we have a really good economy. And in a good economy, we could see that there's going to be better earnings. So if there's low interest rates, that's good for stocks. And if there's high interest rates, it's good for stocks. Is that equation even possible? In other words, everything's good for stocks no matter what happens. I mean,
that's what it seems
ridiculous.
like, right? I mean, that's what it seems like. It just seems like everything's good no matter what. Everything's good for stocks. But when does that change, Andrew? I mean, when is that going to happen where, you're looking at some of these stocks, sectors are going through the roof? It's got to change sooner or later, right? I mean, you want to ride the wave up, of course, but
yeah.
Go ahead.
If you see interest rates popping past 2% and they are there very, for a period of time that's not going to change, that's going to be a real issue. Now, the main issue here really about how interest rates impact stocks, it has to do with the risk-free rate of return in what's called the capital asset pricing model. When you utilize the let's say 10-year or 2-year, depending on what you're using, as a risk-free rate of return, you put that into calculation and you look at earnings or dividend discount models and you try to then project, okay, how much growth can I get and what am I willing to pay for it? The lower the interest rate, the more I'm willing to pay for something because I get a better opportunity. And as interest rates move higher, obviously you pay less for it. So the thing is, though, that if interest rates move up slowly but surely, not a problem, because that does indicate you have a stronger economy. That is a benefit to earnings. And what happens is that your earnings and your will grow into the multiple. However, when you get a skew event like we saw recently, when we went from the beginning of the year to somewhere about 1% on the Treasury on the 10-year up to about 1.75%, that's a very significant move very quickly. It's kind of like the frog boiling concept where you could put a frog in a warm bucket of water and they'll kind of sit there all day, put a flame under it, they'll hang out, and you'll end up having soup. Whereas if you throw a frog in a boiling pot, what's going to happen is they're going to immediately say, no good, I'm out of this. And they're going to freak out and jump out. So it is kind of the same thing when it comes to interest rates. If you can slow boil it and slow cook it, what's going to happen is people will get used to it and become accustomed to it. If it goes up too fast and you get these events, what really are off-putting to your capital asset pricing model, it really does take its toll on some of the more growthier names in the universe out there. And that is exactly what happened this year.
Your food analogies are killing me, buddy.
We can talk about my hamburger theory if you want. No, I'm kidding.
so yeah, I know, right? So okay, let's bring this all together then. So, we're seeing a lot of froth in this market. We're seeing, the certain buzzwords, right? If you and I create, a space program, it'll probably have a $10 billion valuation if we have all the right buzzwords. Doesn't matter if we, 10 years from now, if we actually have something that's going to, shoot to the moon, and then we can ride. But, even when we look at the ESG trend, which, we'll get into in a second because, I'm just so pissed at seeing this. But what are your, you know what? We can go to ESG because ESG is another sector. Where I'm going this is what are the sectors you're looking at? We've seen sectors come down a lot, but we also see a lot of froth out there. And maybe we could start that before the ESG conversation, because what are some of the sectors that you're seeing where utilities are still weak? The Russell 2000 growth are weak, NASDAQ 100 a little weak. These are the ones that are underperforming this year while value cyclicals are up. Where are you looking for new ideas here?
So we use a quantitative screening process to find the stocks, and wherever the particular stock comes from doesn't really matter to me, right? It could be theoretically a utility or a bank. It could be a technology or healthcare. What I'm looking for is consistency of earnings. I'm looking at growth of earnings. I'm looking at consistency of revenue and growth of revenue. I'm looking for certain volume metrics to make sure we don't have a liquidity problem inside there as well. I'm looking at high return on equity. There's probably about a dozen different metrics that I'm looking for. What's interesting to note is that we got a lot more names into that screen that came through the screen in the last go around about a month ago. That was good. We're seeing some of our technology names, particularly in the mobile advertising space, like a Digital Turbine, symbol APPS, just go through the roof. Another one that I would have never picked, never, if you would have given me, okay, just all right, go out there, Andrew, and find something. I would have never picked Williams Sonoma, but our screener picked it. And that stock is on fire. Have you seen that stock chart? WSM?
No, I haven't seen it. No, but I'm very familiar with the name.
Unbelievable.
Yeah. But a lot of stocks,
this is a company.
Right? It's crazy. Go ahead.
A lot of stocks, but this is a company that overcharges, all-time high, by the way, overcharges by about 40% from the same product you can get on like an Amazon or a Bed Bath & Beyond. And people are doing a lot more with that. And again, it's amazing how well that's been doing. A Taiwan Semiconductor, for example, has been in our portfolios for a while, done really well. It's been in the car space. It's kind of a one-of-a-kind type of, even with this shortage of chips right now, doing very well through all of this. So it's really, I would rather lean maybe on banks are not a big part of what we do, some of the financials, but I'd rather lean on some EV right now, possibly the recovery plays to a degree, shorting some of the recovery plays. Well, we're short Planet Fitness. Don't understand how that company almost hit an all-time high recently after the last two earnings reports and pulling guidance. I just don't understand it at all. We had a short about 87, now trading about 76. There's a variety of areas that look like there's going to be some great opportunity. Some of the SPACs in the EV space, that looks like there's going to be a lot of attraction in that area. Some of the pot stocks, a couple of names that come to mind in that area, as we're seeing that many of the states are going to require to have more taxation brought in, and they got to figure out how are they going to do this. Well, they could do it with some of their alternative areas, like whether it's going to be online gambling, tax that possibly, whether it's going to be sin taxes, and whether it's going to be like, for example, pot that they're going to bring in, allow, legalize, and then tax. That's the game.
And lots of ideas there. I really appreciate it. Now, let's get to this ESG thing, because you know as well as I do, it's just a lot of this is BS, right? I mean, this is people's agendas. Yes, there are concerns and everything, but just the fact that I'm listening to every single conference call and they have to, everybody cares about it now. It's such a big deal and everyone has to be politically correct. I'm sick of being politically correct on this because at the end of the day, you're looking at Wall Street charging more price, getting more money. You're looking at SPACs. These guys really don't care. That SPACs are a quick profit mechanism and they're out of it. They're going to talk about this is a great ESG company and be out of it. But yet, some of these names have gone up tremendously and they've pulled back. Is this still an area to invest in? Because even though a lot of it is BS, it's being fed by politicians, and a lot of it, I mean, even when you look at Al Gore and what he did, the amount he was worth $2 million before the presidency, he's worth hundreds of millions of dollars now. But the amount of money he positioned himself to benefit from all that and Inconvenient Truth, which I think we're all supposed to be underwater by now. I think that was like 3-4 years ago, but we're all okay for some reason, which is crazy. But remember, when all this crap and garbage comes up, it's always about how do we make the most money off it, and we want to be there too. Regardless, that's the policy, that's the administration. Everyone's focusing on it. There's more money that's going to go into it. How do you make money off of this? Because again, I don't want to go on too much of a tirade and a big rant here.
Well, let's just for a moment, let's describe to the audience what this is. ESG stands for environmental, social, and governance. What they're trying to do is find companies that have a good environmental footprint, number one. Number two, they also have a good social agenda. Number three, they have a good governance, which means things like making sure they have the ability to have a range of succession plans and overall board membership that is, as you said, politically correct of the day. So what they found was somebody did some digging and they did some scoring and they came up with this kind of process to figure out, okay, let's see how companies that have a good, according to this metric, environmental footprint and that are socially conscious and that have a good governance program, how do they do compared to those that don't? Again, this is an arbitrary and somebody coming up with this whole model. And what happened was that whether it was because they forced it and they came up with this, or whether it was true, it seems that these ESG companies that really had a good idea of putting these three things together, outperformed those that didn't have a good score. Now everybody caught on, and now all of a sudden there's an official ESG score wherever you look. You probably can pull up some of your stocks, and there's somewhere on there, there's a screen that says, here's their ESG score, right?
Mhm.
And a lot of people are investing according to that. And what is also going to happen potentially is they're going to try to persuade the S&P indices to come up with a high ESG score index. And so what's happening is that a lot of people are gravitating this to feel better about what they're investing in and to look at those companies that have all these things, because historically it's been good. Now we have a good amount of history with this that they can provide. I think it's more of a theme and it's gimmicky. It's kind of like, oh, we're only going to invest in companies that have, for example, years back that don't have any sin in there, right? Tobacco and firearms and liquor and gambling. We're not gonna have that at all in our portfolios. I don't know. That doesn't make any sense. What are we doing? Are we investing to feel good? Maybe the millennials and the Zoomers and others want that. What makes me feel good about when I invest is the same thing that makes you feel good, Frank. What is it? It's profits.
Making money. Yeah, making money.
That's it.
Absolutely.
So I want to make sure that I'm not burning down the rainforest. That's probably something that I'd find important, right? Or that I'm not killing, indigenous people of some land somewhere to do what I'm doing. I get all that. Okay. However, the fact is that, this is all about investing. We don't want anything going on that's reckless and odd and it's and hurtful. But at the same time, I find that this ESG thing is an interesting component to add to your analysis, but not the analysis on its own, what they're trying to make it out to be. They're taking a shortcut and saying, hey, we're only going to buy the high ESG scoring companies. I'm not exactly sure what a company that has a good environmental footprint, by the way, which may be greenwashing. You have to remember the word greenwashing. They're trying to figure out a way to come up with a high ESG score any way they can, where they got to cheat to do it or come up with buying carbon credits or whatever it is. And the fact is that that's not really what was the whole thing was created for. So companies are now trying to do a bit of a shoe-in to show themselves as high ESG scorers and therefore make it into the screens. And that's not exactly what the plan was all about.
Yeah, it'd just be nice if companies could think on their own. And if you don't have this policy and people hate that, then maybe people don't invest in it. But the fact that they get mandated and pushed into this stuff, and a lot of it's going to be BS anyway, like you said, all about a score. It's just sad, right? That's politics. That's the way our environment is right now. That's the way, the climate is right now.
They'll figure out how to and if it's all about money, they'll figure out how to boost their score artificially.
Exactly.
That's what they're going to do.
All right. So look, we will leave it there. Thank you so much for coming on, but I did want to give you a shout out for, let me know or let my audience know where to find you. They know we're good friends, and I do have your nice Discipline podcast up here, as you could see, which is cool.
Oh, there you go.
And how long have you been doing the podcast for? A little bit longer than me, I believe, right?
Yeah,
15 years at least?
2007. This is our 14th year, consecutive year, 700 plus episodes. This next week coming up is actually the first guest that I ever had on my show. I got him back. Brian Freeman's going to be Brian Freeman. He was just a guy that was involved in radio, involved in podcasting back then. He was the first guest I had on. We made some predictions. So we're going to bring him back for a 14-year reunion.
That's awesome. If someone wants to get in touch with you, gave me Twitter address.
My kids gave me this. Can you see this? Wait.
Oh, that is really, really cool, actually. That is awesome. Wow, that is awesome right there. That is really, really cool. Look at that.
There you go. Go over to the disciplineinvestor.com. Check out all the things that are available there, from our strategies, from what we do, the TDI Managed Growth Strategy, global allocations, our Robo-esque advisor style investology, as well as follow me on Twitter, Andrew Horowitz. And if you want to follow me on the food world, on Instagram, Dad Bod Food Blog.
What was
Dad
that?
Bod, you know I get that.
Is that real?
Dad
is
Bod. That's true. That's real. Yep. Dad Bod Food Blog.
Wow, that's cool stuff. That is awesome. By the way, because we do this on video, and sometimes people, but what you were holding up from your kids was just explain what that was. It looked like a little gold.
So this is a little, just a congratulations. It's Discipline Investor Podcast, 14th anniversary, 700 episodes. Congratulations, Dad.
Oh, that's cool, man. That's great stuff. All of it's worth it when you get stuff like that, right? Pretty cool.
Yep, absolutely.
All right, man. I will talk to you soon.
Hey,
and thank
Frank,
you
you're
so
the best.
much.
You are the best.
Thanks, man. Love you, buddy. I'll talk to you soon.
All right, see you.
All right, take care.